28 March 2023, Tuesday, MAO with Cal once again. Guys, I'm having a sore throat here itself, so probably you had to really turn up the volume a bit to listen to me today. But the main thing is this is a must-watch video because I'm going to tell you the seasonal pattern are calling for the bulls to come in. But the bears, in my opinion, are living. And of course, the data are showing that there could be more selling ahead. So let's go into details. Let's go. All right, before that, let's start, right? Let me just do a bit of disclaimer apply as usual. Make sure you do that. And the thing is this, guys, do me a favor. We are going to have my course very soon on the coming 1st of April to the 3rd of April. I'm going to have my TWB Premier 20th intake. So contact Susan at 8868-5030 if you are interested. All right, if you know more about the class itself, right, I got a video that is uploaded yesterday. The only school that read the charts from right to left. Okay, we're the only school in Singapore that do that. So guys, take a look at this video. All right, I'll put a link at the comment box itself. So do come in. Okay, thank you once again. Now let's recap what happened last night. The Dow Jones recovered 194 points again, continue to go up. Well, apparently, interestingly, we have the NASDAQ down by 93 points, something I warned you guys. I was saying that NASDAQ more study will come down yesterday in my this TWB this MAO technical site, right? Remember, because I feel that the NASDAQ counters are going to come off due to the inflation issue and worried. And of course, Microsoft was down by 1.5%, Google down by 2.8%, Meta down by 1.5%, and Apple down by 1.23%. The only one that unscathed was Amazon. Now, the one company that I was looking at was BAC yesterday, and BAC went up by 5% yesterday. So some people say that, hey, Kel, you said this company is having problem, but yet the share go up by 5%. Well, the thing is this, guys, this is not going to be like today, tomorrow thingy. I'm looking at BAC as a bigger, longer haul. I think that this company or this bank may have a problem, and I shared yesterday, so you can look at the video. Now, to me, is that now we know that S&P is up by 3 straight days. Does it mean that the worst is over? Well, I don't think so. In fact, I think it's just a beginning. Now, of course, the current now, the banking sector has sort of what they call the panic has toned down. People are going back and say that, okay, we can still trust the bank and things like that. But like I say again, guys, if the companies that borrowed money from the banks to really can't pay back their loans, and then there's tightening across the board, and if the economy turns into recession, all these will play a part. So we all know that the US authorities have been doing a lot of programs like this emergency lending program for the banks, and of course we also saw a few what they call banks having some help from FDIC, but all this thing is temporary, guys. You must look it beyond. So that's the reason why probably the US side tried to divert attention to by now basically having some little problem with Binance, and hopefully things go well, because we know that if Binance go down, things can get very bad, right? And of course, recently the TikTok CEO, which is Singaporean, was being grilled by the Congress, which I think is very stupid because some of the questions are really ridiculous. But end of the day, shows that it's more like a divergence and actually focusing on the matter. Now, of course, with this Binance into some trouble, we do see the Bitcoin coming down a bit, but you can see from the chart, there's still a lot of support on Bitcoin at 27,000. So as long as 27,000 doesn't break, we are fine. But just take note, guys, my indicator shows there's some selling already by the boys, so we need to just watch it just in case. All right, okay. Now, oops, sorry. Oh, there's some PowerPoint issue once again. Let me just clear it up over here. Here, just be a moment. Okay, on, yeah. Okay. Now, for Mike Wilson, right, it's pretty clear that he is actually still being bearish. Okay, so what did he do? He says that the earnings are the next risk to equity. In fact, he said that the earning projection look unrealistic amid the recent events. I totally agree with that. So the thing is this, he feel that, right, in a 3 to 6 month time, when things up to really the valuation comes into proper, and then people will understand that we are not actually we're still in a cyclical bear market that has not completed yet. Now, do note, Mike Wilson is the ranked #1 for last year as well. And of course, he predicted the selling. And of course, the thing is that he's still looking at this year to sell some more. But of course, we can see the S&P is now going up instead. So whether he's right or wrong, I'll leave it to you to decide. But to him, it's that the turmoil in the banking sector has left earnings outlook too high. And that will definitely cause earnings to be affected. And then after that, there will be a repercussion. So rather than I tell you what he say, all right, why don't listen to him personally and get the best out of it.
Areas that you think have sufficiently repriced, where you're starting to see opportunity? Well, look, I mean, financials have started to reprice in a meaningful way. Now all of these companies are going to have problems. That we're seeing in some of these. So yeah, I think it's happening. I mean, the other thing I would just point out is that financials tend to lead the overall market, but that's one area for sure. Some of the retail, some of the consumer areas have repriced. They've been repricing for years. We just added a name to our fresh money buy list today as a retailer. So I think there are definitely areas. And markets go through these periods with, I call it a rolling bear market, rolling recession. We've kind of, I think, came out with that view a few years ago. Now people have used it, but that's the way it works. And we're looking for opportunities now at the stock level, but at the index level, it just does not look attractive to us.
So Mike Wilson. All right, so you can hear that he's basically saying that this is still ongoing and risk for equity is elevated. Okay, so that is from Mike Wilson. So we can see that this is his chart. He feels that, right, the blended forward EPS right now, the earning per share is really at the high level. Okay, so where we are is here. And that is not a good sign because the S&P now is trading at this area here. So if let's say that the is too high, and of course when it's too high itself, right, the versus the price action here, things can get worse. So that means that there could be further downside for the S&P 500. So that's why if you look at it, right, it's looking at about 3,005 to 3,006 to be at a fair value. Okay, so guys, think about it. Let me know your in the comment box itself. All right. Now, for me, right, the more important thing is layoff is increasing, and we saw Walmart is laying off hundreds of workers at the e-commerce facility, and this is an ominous sign for the economy, indeed. And if you look across the board, you can see that not only Walmart, we have Meta knocking off 10,000 people, Disney 7,000, Zoom 1,003, Dell 6,005, PayPal 2,000, IBM 3,009, and the list still go on. So if you add them all together itself, you have easily 50 to 100,000 people being laid off very, very soon. But of course, for 100,000 layoff in the in a 200 million workforce itself, it's really nothing. You can say that, but still it will have some effect, right? So that's the reason why right now you can see from the economic data that now the credit cards is your usage and the debt is soaring at an incredible rate, while saving itself is getting lesser and lesser and lesser. Of course, recently there's an uptick of saving because the money is being pulled back from the banks, but then again, this is not anywhere near that we saw back here in 2020 during the pandemic period. So now the credit card utilization and debt is so much higher, it's almost twice than pandemic period. So what do you think, guys? Things can get really very scary. And of course, now we are into the 23rd straight month where American cost of living has outpaced their wage growth. That means that they are spending more money than their wage growth itself. So this is again a very big telltale sign that things may get very, very bad soon, because we have seen it before back in 2007. That was before the market crash. Already this phenomenon has happened, and then we have again in 2011 where the stock market came down by almost 2,000 points for the Dow Jones. We saw that happen again, and now we are now here. It's like, wow, think about it for a moment. Yeah, so things are not really going according to plan. So if you look at the leading economic data right now, you can see that it's very clear. The EOCI index is coming down right now, and the federal fund rate, effective rate, is going up. So all this, when you can see in the past history, when the data is coming down, while the Fed fund rate is going up, you do see the thing recession, the gray area here. So you can see that every time when this data is going up and this data going up, you can see a recession and so forth. So definitely, in my opinion, recession is coming in, but of course, a lot of people don't think so. I'll just leave it there. I'm not going to debate, because we all know what happened in about 6 months to 9 months time. And more important thing is that right now you can see that the S&P EPS growth rate is coming down at a very fast speed. Why? Because you can see when a Fed fund rate increases, right, you do see the repercussions, the post effect will be that the earnings will drop, because obviously no companies will want their cost to increase. So whenever the Fed increase interest rate, you can see that the earnings itself will go down. So definitely now we are here, and of course Fed fund rates probably will still go up a bit more, and that will add on pressure on the earnings, and that's why I think Mike Wilson is saying that. Okay, but it's a different article that we are sharing now, because that Mike Wilson didn't cover this area with this charts here, but just showing to you with the collection here. So the thing is this. the banks are starting to tighten. You can see right now, it's very clear the banks are tightening up. So you can see that when they tighten up, right, that was all the period back then, and that usually leads to recession. When a bank tighten up, it leads to recession. The gray area are the recession area. So of course, the recession should be coming up next. You don't need to be a guru to know this because it's pretty clear, and historical pattern usually will repeat once again. So if you look at it right now, the leading economic data versus the EOCI, the one that we showed to you, all right, it shows that, right, there is a very high chance that we are going to see a recession, because when these two numbers go below the 0 mark, you can see that it's always a recession indicator. So all I can say is brace yourself, guys. 6 months to 9 months, in my opinion, is August 2023, we will see recession coming in. All right. Now, of course, you've been hearing me about recession. You're getting bored of it. All right. Is there anything that is positive, Cal? Of course there is. Let me show you now. Now, the thing is this, I cannot deny that there's this seasonal pattern chart that's going around, and it actually based on the last 20 years since 2020 to 2022. But you must understand the last 14 years, we have the QE all the way. So if you're just going to base on that itself, right, may not be enough. But again, I'm not going to debate here, because why? Based on the seasonal pattern, we are almost the end of the trough period, and very soon by April, we should see a gigantic bull market for the entire April month. Now, I cannot deny this, that we will have a recovery, but I don't think it will happen in this few months. In fact, my view is here. I think that, right, the market should be going down bit by bit until August, and before August itself, we see some selling. But again, that is my view. On the seasonal pattern, it does show that the market has a lot of room to go up, right? So that is something to take note. And of course, if let's say we put VIX in the picture, you can see that now VIX is probably at the time that it will collapse. And of course, we all know that when VIX collapse, that means the stock market is going to rise. So again, the seasonal pattern call for bull. All right, I cannot deny this. I need to show you the both side of the cam, but I got concerning factor here, because if you look back again in 2016, right, that's where people are saying that this is where the market will recover. So, sorry, my bad. Hold on, there's some PowerPoint. Hey, sorry, a moment. Okay, okay. So now people are comparing this. They say that the 2016 is seemingly the time where the market is calling for buy. So if you look back in the chart right now, right, you can see that now the so-called hedge funds, right, their long and short ratio is at the low end, because now 2023, you can see that at low end, and it happened again in 2016. So that means that the hedge funds itself, right, they are not buying yet. Okay, in fact, they're quite bearish right now. So if you look back into history, when the hedge funds are very bearish, this could be a market turning point. So that is the reason why I'm sharing this with you. And if you look more into detail, sorry, yeah, I missed out one chart, I think. Oh gosh, hold on a minute, yeah. Gosh, sorry guys, a bit of technical issue. Oh gosh. Okay. One more. Hey, sorry, I think something wrong with my PowerPoint slides now. Yeah. Okay, I think let's go backward again. Sorry for this. Okay, now you can take a look here yourself, guys. This is the CTAs, right? The CTA positioning are also at the low end. The CTAs are now at the low end. And then what happened? The last time we saw something like this was back in 2016. So that means that a lot of funds are not coming in the market right now. They feel that, right, this is not the right time to go in. So with funds missing out here or not involved, then why the stock market is holding up? It's because some other fund, which I think is a Federal Reserve, is holding up. That's why they put in $300 billion into the market and basically putting people into that. So Cal, if that's the case itself, isn't that 2016 going to be a good showing? Because 2016, that's market bottom, right? Okay, let me bring the chart to you right now. You are right. In 2016, the market did actually came down a bit. And then after that, we can see from the market after 2016 is over in 2017. All right, the market went into a real big bull market. So over this period of time, the market did come down a little bit, then bottom out, and then start to move higher, right? So by right, you say, Cal, if 2016 is a repeated pattern, then 2023 to 2024 should happen. Okay, the only thing I want to hold you back a little bit here is, guys, look, okay, back then itself, right? Do understand this. The inflation back then itself, right, is at the low end of 1.0 only. And then back then itself, right, the unemployment was actually moving upwards. Okay, the Fed fund rate, sorry, the Fed fund rate is just moving upwards, and the time the Fed fund rate is only like, how much is that? Only less than 1%. So which means that, right, the whole thing, you must understand the CPI data back then itself is only 1.0 and the Fed fund rate was only 1% back then. This is something that you must understand this, okay? Because those were the key element of for stock to go higher. But if you look back into now, current today market, right? We just take a look. We are a bit different right now, guys. We have the Fed fund rate at about 4.75 going to 5. And we also have the CPI data at about 3.4. Sorry, I don't think it's 3.4, it's 6. Sorry, my bad. Okay, it's at 6.1. Yeah. So think about this. We are so far different from then. All right. So of course, you say if they cut interest rate, wouldn't that be good? That will be what happened in 2016. But you must understand, if they cut interest rate down, then the CPI data will shoot up. So now we are in a very different position right now compared to 2016. So if you ask me, right, the best thing to happen is let the market slide, let the market collapse. Then when things get so cheap, then inflation will be dropping, and then you cut rate will be the perfect cocktail for a bull market. What do you think? I think that should be the best outcome, right? All right, so one thing to watch out for is crude oil. Crude oil has climbed up. I've been calling for buy on crude oil. I tell you guys, we should see crude oil going up again. So indeed, it happened. So of course, we all know that the main thing is that now is the this Kurdistan export halt, and then we have the bank cheaters over, so people are buying into it again and stuff like that. But regardless of this, if crude oil goes up, it's out, inflation reduce, worry will come back again, and of course that means that interest rate will have to go up again. So think about this, the overall package. Do you think the bull is ready, or the bear still not living yet? All right, guys, I'll see you later on the technical side. This is Kel signing off. Bye bye.